Every major economic collapse in history shares a striking paradox. Prosperity often precedes the deepest crisis. Governments borrow heavily while citizens feel wealthier, masking the fragility beneath the surface. In 1929, the United States reached unprecedented stock market highs while household debt surged to record levels. By October, the illusion of stability shattered, revealing systemic vulnerabilities that had been ignored for years. This is not an isolated incident. Patterns repeat across centuries and continents. Debt accumulation, monetary expansion, and currency stress often converge to trigger collapses. The first step to understanding these patterns is recognizing the economic framework that drives them. At its core, it is a cycle of borrowing, spending, and delayed consequences. Governments issue debt to finance spending, often at interest rates that appear manageable. Citizens and investors perceive growth and security, but the underlying obligations compound quietly over time. Banking systems amplify this dynamic through credit expansion. Loans create money, stimulating short-term growth while embedding long-term vulnerabilities in the financial system. Central banks play a pivotal role in this mechanism. By lowering interest rates, they encourage borrowing and asset speculation, often inflating bubbles that will eventually burst. Inflation is the silent consequence of excessive credit expansion. Prices rise as money supply increases, eroding real purchasing power and sometimes triggering panic when it accelerates too quickly. Currency value is another critical pressure point. When debt grows faster than the productive economy, confidence in the currency weakens, leading to devaluation and sometimes a flight to alternative assets. This framework has repeated across history, leaving clear warning signs for modern observers. From Rome to Argentina, the sequence of debt, credit expansion, inflation, and collapse is remarkably consistent. Take the example of Weimar Germany in the 1920s. The government printed massive amounts of currency to pay war reparations, and by 1923, the Reichsmark had lost almost all value, with prices doubling daily. Citizens scrambled to buy tangible goods, converting money into food, fuel, and real estate. Hyperinflation destroyed savings, destabilized society, and paved the way for radical political change. Italy and Spain faced similar scenarios during periods of sovereign debt stress in the early 20th century. Excessive borrowing, combined with weak banking oversight, created cascading economic vulnerabilities. The mechanism is predictable. Debt fuels credit growth, which feeds asset speculation, while policymakers often underestimate the lagged consequences. The delay between borrowing and visible collapse gives a false sense of security. In the modern era, this pattern manifests through complex financial instruments and global interconnectivity. Sovereign debt crises now have international ramifications, affecting currencies, trade, and capital flows across multiple nations simultaneously. Historical analysis shows that policy missteps often accelerate crises. Decisions like artificially low interest rates or aggressive quantitative easing can temporarily stabilize the economy, but amplify systemic risk over the long term. Take Japan in the 1980s. Excessive credit fueled real estate and stock market bubbles, with the Nikkei index peaking near 39,000 in 1989. When the bubble burst, it triggered decades of stagnation and deflation, illustrating the long tail of financial consequences. Even highly developed economies are not immune to these cycles. The 2008 global financial crisis demonstrated how excessive leverage, poor oversight, and opaque financial products can quickly transform prosperity into disaster. Understanding the pattern is not merely academic. It allows for recognition of warning signals before a full-blown crisis unfolds. Analysts can track debt ratios, credit growth, inflationary trends, and currency movements to anticipate stress points. As we transition to contemporary application, it becomes clear that history is repeating itself in subtle but significant ways. The same economic forces that triggered past collapses are present in today's global financial system, waiting to manifest under pressure. One of the most instructive examples is the 1997-1998 Asian financial crisis. Thailand, Indonesia, and South Korea faced collapsing currencies and skyrocketing debt, despite years of rapid economic growth. In Thailand, the baht had been pegged to the US dollar, attracting foreign capital and creating a credit boom. By July 1997, foreign investors began withdrawing funds, forcing the baht to float and triggering a 30% devaluation within weeks. Indonesian banks were heavily exposed to short-term foreign debt. When the rupiah collapsed from 2,400 to nearly 16,000 per US dollar by January 1998, the economy contracted sharply and inflation surged above 70%. South Korea faced a similar scenario, with corporate debt exceeding 400% of GDP in some conglomerates. The government negotiated a $58 billion bailout from the International Monetary Fund to stabilize the banking system. These crises were not random. They followed a consistent debt-fueled pattern. Excessive borrowing, over-leveraged financial systems, and reliance on fixed exchange rates created systemic fragility. Moving to Europe, Greece in 2009 to 2012 provides a contemporary sovereign debt case. The country's debt to GDP ratio exceeded 120%, while budget deficits averaged over 12% in the years preceding the crisis. Investors lost confidence and borrowing costs spiked. Greek 10-year bond yields climbed above 30%. Without external support, Greece faced a default that could have destabilized the entire Eurozone. The European Union intervened with bailout packages totaling over $240 billion. Austerity measures, structural reforms, and banking recapitalizations were imposed to prevent systemic collapse. Historical patterns are evident here. High sovereign debt, loss of market confidence, and reliance on external support characterize most modern collapses. Policy delays often exacerbate the economic pain rather than mitigating it. In Latin America, Argentina's 2001 default illustrates the consequences of prolonged currency and debt mismanagement. The peso had been pegged 1.1 to the US dollar, while debt to GDP ratios soared above 50%. By December 2001, Argentina defaulted on $95 billion in sovereign debt, the largest in history at the time. Social unrest erupted, and the economy contracted by nearly 10% in a single year. Banking systems were paralyzed as depositors withdrew funds, leading to widespread closures and capital flight. Hyperinflation followed, with the peso losing over half its value within months. Venezuela's more recent experience is another example of monetary collapse. Excessive money printing to cover fiscal deficits led to hyperinflation exceeding 1,000% in 2018. Currency devaluation destroyed real wages, and GDP contracted by over 25% from 2013 to 2019. Import reliance made the crisis even more severe, highlighting the interplay between fiscal mismanagement and external exposure. Across history, collapses share identifiable triggers: fixed exchange rate vulnerabilities, over-leveraged banks, and unchecked sovereign borrowing. These triggers often intersect with political decisions and global capital flows. The United States in the 1970s faced inflationary pressure after abandoning the gold standard in 1971. Combined with oil price shocks in 1973-1974, CPI inflation exceeded 12% by 1974, eroding purchasing power rapidly. Policymakers attempted to control inflation through wage and price controls, but the measures failed to address the root causes of monetary expansion. The subsequent recession underscored how delayed policy responses amplify economic stress. Germany's post-World War I hyperinflation offers a more extreme illustration. In 1923, the government issued over 300 trillion marks, turning a loaf of bread from 250 marks in January to 200 billion marks by November. This demonstrates the destructive power of unchecked monetary expansion on societal stability. Confidence in the financial system collapsed, leading to social unrest and political upheaval. These historical cases reveal a common pattern: debt accumulation, excessive credit, currency instability, and delayed policy responses. The lesson is clear: ignoring systemic warning signs almost always magnifies the eventual economic pain. Today, global sovereign debt has reached unprecedented levels, surpassing $90 trillion as of 2023. Many advanced economies carry debt to GDP ratios above 100%, echoing the warning signs seen in historical crises. The United States alone holds over $33 trillion in national debt, with annual deficits exceeding $1.5 trillion. While growth continues, the compounding interest obligations are creating a hidden structural pressure on the economy. Central banks around the world have implemented aggressive monetary policies. The Federal Reserve, European Central Bank, and Bank of Japan have purchased trillions of dollars in government bonds to stabilize markets and stimulate growth. Quantitative easing has expanded central bank balance sheets to record levels, exceeding $9 trillion in the U.S. alone. This flood of liquidity inflates asset prices while potentially sowing long-term instability in the financial system. Low interest rates encourage both private and public borrowing. Corporations leverage cheap credit to buy back shares or expand operations, increasing systemic debt without corresponding productivity gains. Household debt is also climbing, particularly in housing and consumer credit. Mortgage debt in the U.S. has surpassed $12 trillion, while student loans exceed $1.7 trillion, creating vulnerability to interest rate shifts and economic shocks. Inflation, once subdued for decades, is returning with force in many economies. CPI growth reached 8.5% in the U.S. in 2022, reflecting the compounding effects of supply chain disruptions, fiscal stimulus, and expansive monetary policy. Currency stability faces similar challenges. The U.S. dollar remains the primary reserve currency, but rising debt and persistent deficits are prompting speculation about its long-term strength. Emerging markets face even greater pressures. Countries like Turkey, Brazil, and Pakistan experience high debt-to-GDP ratios, volatile exchange rates, and inflation rates exceeding 20%, mirroring historical sovereign stress patterns. China, the world's second largest economy, shows signs of credit overextension. Local government financing vehicles and corporate debt now exceed $5 trillion, raising concerns about defaults and systemic spillovers. The global banking system, interconnected more than ever, amplifies these risks. A crisis in one major economy can cascade through capital markets, creating contagion effects reminiscent of 2008. Shadow banking and off-balance sheet financial instruments add opacity. Investors often underestimate the risk embedded in derivatives, repurchase agreements, and other complex instruments. Central bank interventions can delay crises, but cannot eliminate underlying structural risk. The repeated use of rate cuts and asset purchases may inflate new bubbles while masking imbalances. The modern economy also relies heavily on digital and electronic payment systems. While efficient, they introduce systemic vulnerabilities. If financial institutions face sudden liquidity stress or cyber disruptions, commodity markets reflect these pressures as well. Oil, wheat, and copper prices fluctuate dramatically in response to currency movements, debt crises, or central bank actions, affecting both inflation and economic growth globally. Geopolitical tensions exacerbate financial fragility. Trade wars, sanctions, and conflicts in energy-producing regions can trigger rapid capital flight and stress currency values, similar to historical crisis accelerators. Sovereign credit ratings provide another indicator of vulnerability. Several countries, including Italy and Argentina, face ratings near junk levels despite nominal growth, reflecting persistent structural weaknesses. Investors increasingly seek safe haven assets like gold, U.S. Treasuries, and the Swiss franc. This flight to security mirrors patterns observed in Weimar Germany, Latin America, and Asia during past crises. Modern derivatives markets magnify exposure to debt and currency risks. Interest rate swaps, credit default swaps, and leveraged ETFs can turn localized stress into broader financial instability. The pattern is unmistakable: excessive debt, credit expansion, inflationary pressures, and currency vulnerability. While the scale is larger today due to globalization, the underlying mechanisms remain consistent with historical collapses. If current debt and credit trends persist, inflationary pressures are likely to intensify. Consumers may face rising prices for essentials, eroding real incomes, and reducing discretionary spending. Governments may respond with higher taxes or austerity measures, creating political tensions and social unrest. Historical precedent shows that delayed interventions often exacerbate economic pain rather than alleviate it. Sovereign debt crises may emerge in both developed and emerging economies. Bond yields could spike, increasing borrowing costs and forcing governments to divert funds from infrastructure, healthcare, and social programs. Currency devaluation becomes a significant risk. A weaker currency increases import costs, accelerates inflation, and reduces international purchasing power, particularly in economies heavily reliant on foreign goods. Banking systems are vulnerable to sudden liquidity shocks. Depositors may withdraw funds en masse if confidence erodes, creating a modern-day bank run similar to those seen in 2008 and the Great Depression. Asset bubbles in housing, stocks, and commodities could burst under these pressures. Over-leveraged institutions and households could face insolvency, amplifying the crisis through credit defaults. Central banks may face difficult trade-offs between controlling inflation and supporting growth. Raising interest rates could stabilize currency value but trigger debt servicing challenges, while low rates prolong inflationary pressure. Global trade could contract as capital flight and currency instability spread. Export-dependent economies may experience sharp GDP contractions, similar to the Asian financial crisis of 1997-1998. Social consequences are likely to follow economic distress. Rising unemployment, inequality, and poverty often accompany currency collapses, creating conditions for political instability and civil unrest. Fiscal and monetary policy coordination becomes critical in mitigating systemic risks. Countries with greater flexibility and reserves may weather the storm better, while those with structural imbalances face severe disruption. Sovereign defaults, while rare in advanced economies, remain possible under extreme stress. The cascading effects could impact global banks, pension funds, and investment portfolios, creating widespread financial contagion. Inflation-adjusted savings could be wiped out, particularly for retirees and low-income households. Historical examples, like Weimar Germany and Venezuela, demonstrate the devastating societal effects of unchecked currency devaluation. Commodity-dependent economies face compounding risks. Declines in oil, metal, or agricultural prices reduce revenue, weaken currencies, and amplify fiscal stress, accelerating the debt inflation cycle. Interconnected global finance means that localized crises can rapidly become international. A debt crisis in one country can trigger capital flight, rising interest rates, and market volatility worldwide. Central banks may resort to unconventional policies, including negative interest rates or direct monetary financing of government debt. While temporarily stabilizing markets, these measures risk undermining long-term confidence in the currency. Private sector leverage adds further systemic fragility. Highly indebted corporations and households amplify credit contraction during stress, deepening recessions and slowing recovery. Technological disruptions in payment systems and fintech platforms may introduce new risks. Failures or cyber attacks on critical infrastructure could trigger liquidity crises and amplify financial panic. Investor behavior will increasingly reflect risk aversion. Flight to tangible assets like gold, real estate, and foreign currencies may accelerate, putting further pressure on domestic markets and exchange rates. Public perception and confidence are central to economic stability. Loss of trust in governments, central banks, or financial institutions can turn technical vulnerabilities into full-blown crises. The cumulative implication is clear. A combination of rising debt, credit expansion, currency instability, and delayed policy responses could trigger a global economic reset. The severity depends on the speed, coordination, and credibility of policy interventions. Conventional wisdom assumes that modern economies are immune to past mistakes due to technological advances and central bank tools. History proves otherwise, showing that human behavior and financial incentives remain largely unchanged. Credit expansion and debt accumulation are natural in growing economies, but without restraint, they amplify vulnerability. The illusion of stability often precedes sudden disruption. Markets respond to perception as much as reality. Confidence in currency, debt sustainability, and banking institutions drives liquidity, investment, and overall economic activity. When confidence falters, technical problems escalate into systemic crises. A minor shock can snowball into a full-blown economic collapse if trust erodes too quickly. Sovereign debt crises are often hidden by accounting conventions and financial engineering. Off-balance sheet obligations and contingent liabilities mask the true scale of fiscal vulnerability. The United States, Europe, and Japan exhibit these hidden pressures today. Trillions in unfunded obligations and social spending commitments create latent systemic risk. Investors and citizens alike underestimate how quickly modern credit systems can unravel. Sophisticated financial instruments can amplify losses at speeds unimaginable in historical contexts. Yet the patterns remain consistent across time and geography. Debt accumulation, excessive leverage, currency stress, and delayed policy response form a near-universal sequence preceding collapse. The contrarian insight is that crises are not necessarily caused by shocks, but by the accumulation of predictable imbalances. Recognizing the pattern allows for anticipation rather than reaction. Modern policy emphasizes short-term stabilization and at the expense of long-term resilience. While markets may rally temporarily, systemic fragility continues to grow beneath the surface. Historically, those who understood these cycles were able to protect wealth and mitigate losses. Diversification, liquidity, and risk awareness have consistently provided buffers against collapse. Currency devaluation and inflation often serve as corrective mechanisms. While painful, they are nature's way of rebalancing unsustainable debt and restoring confidence over time. Banking crises accelerate these corrections by forcing defaults and restructuring obligations. Institutions that appear stable can fail rapidly if systemic confidence deteriorates. Sovereign defaults, though politically difficult, often become inevitable when fiscal and monetary policies are unsustainable. History shows that delayed action only amplifies economic and social pain. Recognizing these patterns shifts the perspective from panic to preparedness. Understanding the mechanics of debt, credit, and currency stress allows policymakers and investors to make informed decisions. Modern economies are extraordinarily complex, but complexity does not eliminate the fundamentals. Debt dynamics, currency confidence, and systemic leverage govern outcomes regardless of technological innovation. This insight reframes how citizens should view economic growth and government spending. Apparent prosperity may coexist with hidden fragility, demanding careful scrutiny rather than blind optimism. The lesson is clear. Your money is exposed to structural forces beyond individual control. Awareness and prudent financial management remain the most reliable safeguards in an uncertain system. History repeats, not because events are identical, but because human behavior and financial incentives remain predictable. By studying patterns, societies and individuals can better navigate the risks that lie ahead. The choice is not between fear and ignorance, but between awareness and preparation. Understanding the underlying economic forces empowers viewers to act strategically, safeguard wealth, and interpret future developments with clarity.